Let's take a look at the US dollar and how this is impacting US stocks. Now, in case it hasn't been obvious yet, we are seeing significant outperformance by global equity markets. If you look at this here, you can see the year-to-date performance of, for example, the German DAX and the Chinese Hang Seng, all the way up, 18, 19, 20 plus percent versus the U.S. indices, which are flat to, down as much as, 2, 3, 4%. We actually think this is a broader shift that's taking place. We don't think it's going to be linear. We don't think that the U.S. equity market's going to crash and stay down, 30, 40%. Crashes are always outlier forecasts to begin with. But we do think there is a very important shift going on, and we see very few people willing to listen or willing to implement. A lot of people are listening but not really making any changes because they haven't felt enough pain yet, and that's typically a bit of a dangerous sort of concoction because it can lead to everyone then making the decision to change at the same time, in which case certain stocks will then go down a lot more than people think, and some of them will go up a lot more than people think. Like maybe European indices might then get very overbought over the course of time pretty quickly, mean revert, and then maybe go back high again. So here is what I'm trying to get to. If we look at the dollar index, and this is the DXY, we can use the trade-weighted one, which I'll show you in the next chart, which is really important. We've seen a pretty meaningful decline in the dollar, basically since it topped, at least so far for the year, on January 10th. It's, as I'm recording, down about 6%. That's a really big move for the dollar in currency terms. Maybe it's making a lower high, a confirmed lower high versus the December 2022 highs. Too early to tell. The point is, what we think is happening, and this is a really, really important chart that I found on the internet, on Twitter, I should say. It's something called the trade-weighted dollar index. So basically, the details don't matter so much for the purpose of this, but essentially what this is, it takes the US dollar index, or the US dollar, if you will, and it weighs it in terms of its trading weight to the US. So it's not equally weighted, right? It's almost like an index. The point is, this is a long-term chart. It goes back all the way down to the 1910s. And you can see 3 times, one time in the 1930s, I think it is, one time in the 1980s, and now has the dollar index reached these levels. Now again, we're not calling for the end of the world here, but this is important because you can see when it mean reverts the dollar, it doesn't do so gently. It does so quite aggressively and continuously. At least that's how it is done for the past 80 years, the 2 times other examples we have. So this is a very rare circumstance we're at right now. Why does it matter for you as a stock person if that's where your focus is? And assuming the assumption here is that a lot of people that's where their focus is. Here's why this is important. So over the past 10 to 15 years, the U.S. equity market has, rightly so, sucked a lot of the global liquidity and capital into it, right? Sucked up a lot of that liquidity. All the money, another way of putting it, all the money has been now allocated to U.S. markets. A lot of it in Mag 7 stocks and so on and so forth. We all know that. Which has been a direct result, or the dollar, I should say, which on this chart here is the blue line, has been a beneficiary of that, of course, because let's say you're a foreign private bank or a foreign central bank even, or a sovereign fund, and you're buying Mag 7 stocks, let's say, you of course have to buy dollars. So the dollar went up, which is the blue line here. So there's a pretty good positive correlation, and I would argue it's gotten very disconnected, where you can see the equity market, the S&P, got very disconnected from the dollar. Now the dollar does tend to have a bit of a leading offer sort of a leading signs, and I think the fact that the dollar is now potentially making lower highs versus those 2022 highs is potentially very, very important. So again, I point this out because it's one thing to be in the market and trade and take advantage of all the opportunities we're seeing against the year of the trader. I've been talking about this now for a long time, and I continue to talk about it. But I think there's a real risk that a lot of U.S. investors are going to miss this very large shift where the S&P might just flatline for a number of years, 5 years plus. And for a lot of people that are in the market, that is an unacceptable price action. Now, remember, the S&P just rallied 50% in 2 years, so I'm not quite sure anyone should complain upon a flat S&P for a number of years. But people are not expecting it. They have very different expectations. They've even adjusted their cost of living, or their living expenses, I should say, their lifestyle, to that expectation. And that's very, very risky because there's going to be other parts of the world that might do very well. And the dollar here, I think, is telling us a very interesting picture. Again, I'll end on the big picture chart, which is this one here. So you can kind of see how historic these levels are right now. I hope it helps. I'll see you again in the next video.